Canada's housing market is facing a slower than normal spring season, with a high interest rate proving to be a stumbling block, keeping many from buying a home. Experts say any chance of an immediate Bank of Canada shift away from a 5% overnight lending rate appears to be unlikely.
We think it's a long shot. The bank will probably want to signal ahead of time something a bit more clearly that it's turning a corner.
The central bank has held the rate at 5% for 5 consecutive announcements. With many projecting a decrease halfway through this year, real estate companies are telling clients to prepare for what could come this summer. A shift in the policy rate could see a flood of listings and buyers back into the market, which Canadians witnessed last spring when the bank held its rate at 4.5% in 2 announcements before raising it twice in the summer.
If we all of a sudden see buyers jump off that fence and into the marketplace all at once, we could start seeing upward pressure on prices. We don't really want the gates to open up too quickly. We want buyers to have a chance to get into the market, have time and comfort in making an important decision.
Earlier this year, Royal LePage surveyed its clients and found that of home buyers who paused their decision to purchase a home, about half of them will look to buy once the central bank drops the interest rate. About a quarter of that group noting interest rates would need to drop more than 100 basis points before dipping a toe back in the water.
We will need a string of cuts before it makes a real difference to a lot of people.
Governor Tiff Macklem has indicated the bank's eventual cut to rates will not take place as fast as they went up. The decision in March to hold the rate also saw a note by the bank's leaders that the strength of home sales combined with a cut could stoke shelter price inflation. Shelter costs in February 2024 were more than 6% higher than they were in February 2023. Kyle Benning, Global News.